everybody. Welcome to TraderMerlin Show. It is your hump day. Is it? It is Wednesday. Crikey. It's the way the time flies just blows my mind. As you guys may recall, yesterday we had Jim Rogers on the show, and one of the topics he talked about, which was interesting to me, was that he sees the bond market bubble as being the biggest bubble of his lifetime. And I prodded him a little bit, like, how would you capitalize on this? And he gave some basic answers, like, well, let's just go short the bond market or buy these inverse ETFs. But he didn't give a lot of reason as to why he thought this bond market was in a bubble. It's one thing to say something's in a bubble. It's actually another to come back with evidence to support your conclusion of something. So today I think we might dive deeper into it, because long before I've heard Jim Rogers talk about a bond bubble, or anybody on CNBC or Fox or Bloomberg saying, hey, we're in a bond bubble, which, by the way, right now is the talk track. Bill Addiss has been talking about this for quite some time on the inflating of this bubble and the different factors going into it. So I thought, you know what? Let's talk about the bond bubble with, well, one of our regulars on the program at this point. We've got Mr. Bill Addiss joining us today. Bill, how you doing?
Hey, Merlin. Very good to talk to you. How are you today?
I'm much more relaxed than you. In talking to you just a couple minutes before the show, it sounds like you are extremely busy today. Well, walk us through a Bill Addiss day. You got some exciting stuff going on.
Well, it's been interesting. You know, we've all, in the training world and the education world that we're all in, you know, it's moved into a virtual world. So, you know, my day is now spent in front of a Zoom camera, like, you know, with my institutional clients. But the opportunity is we can now go global. You know, what I was telling Merlin before class was, it's interesting. I have a class this morning at 2 a.m. because I'm going to be doing a class for the Asia Pacific region of one of my largest institutional clients. And quite honestly, in the old days, they wouldn't have flown me out there for a 2-hour class. But the opportunity to get in front of the group for 2 hours and deal with the Asian client base and the Asia Pacific client base is a fun opportunity. So basically, it's a 24-hour training is what it's come down to.
Yeah, from the comforts of your own home. That's a nice feature to have.
Exactly.
Well, if you're like me, you kind of miss the physical classroom and the human touch element. I was actually at Online Trading Academy yesterday, and there was a class in session doing Forex with Tim Pessett, which I thought was kind of nice. It's what do they call it? Or a connected classroom where the students are in there, but the instructor's on video, and they broadcast that to multiple centers, which is kind of a new thing. But certainly the interaction I miss.
I do too. I miss the travel and I miss the classrooms. That was the two fun aspects of the job. I hope we can get back to both soon.
I think we will. We're getting there. It was funny because I tweeted out today all these people talking about the Johnson & Johnson vaccine and the Pfizer vaccine, and I go, I'm just waiting for the Kodak vaccine, because remember, they were supposed to develop a Kodak vaccine. Anyway, let's talk about this bond bubble, because...
With the government, by the way, with a government loan.
Yeah, and not just like $100,000. It was, several hundred million.
Right.
Jeez, crikey. I mean, give me a loan for $700 million. I'll create, you know what, you give me that much money, I will create anything that you want. I could find people to make a vaccine for COVID for $500 million. I am in. But it's Kodak, so let's not kid ourselves. Okay. You couldn't even stay with digital cameras, Kodak. Come on.
Exactly.
All right, my rant is over. Bond bubble. We've shown on this program in the past quite a few arguments, charts, graphics to help illustrate why this is a bubble, and maybe later on we'll talk about some of the ramifications of this bubble. But as time rolls on, I feel like the evidence gets stronger and stronger supporting your argument that we are in a bond bubble. So let's talk about it, maybe show some graphics to our viewers about this bond bubble and what it might mean for us.
Perfect. And I apologize, Merlin. I don't have the slides up that you've got. So when you put up the first one, you let me know. But I'm gonna give you the background here.
Okay.
For the group, the bubble is really comprised of two different aspects to it, like any bubble. The first is the supply side. You know, how big the bubble is getting. And what we saw last year is that the world, and U.S. corporations and the U.S. government included, has decided that the way to fuel their growth is by borrowing money. Mm-hmm. You know, if we look, the amount of debt, bonds that were issued here in the U.S. just last year was over $12.5 trillion worth of bonds were issued here in the U.S. last year. Wow. Now, the greatest number we'd ever had prior to that was $8.5 trillion in any one year. So we were 50% more bonds were issued into the market than we'd ever seen before. Now, a good part of that is treasuries, because, you know, we talked about the deficit and all the bonds the government has to issue, but a growing part of that was also corporations. Mm-hmm. You know, last year, corporations decided to really leverage up their balance sheets. And they did it for two reasons. Number one is we had a lot of really high quality issuers that raised money by issuing bonds simply because the financing was so cheap. You know, the interest rate they got. You know, the Apple, in the fourth quarter of last year, Apple issued $14 billion worth of bonds. Now, they did that when they already had $200 billion worth of cash on hand. They literally didn't need the money. But they figured if we can get a cost of funding that's so cheap in today's market, and they literally borrowed $14 billion at less than 2%. Their answer was, why not?
Right.
You know, names like Disney, names like Apple. So we're hitting the market with a lot of issuers, but then you also have the other end of the spectrum, which is the more dangerous, which is the junk bond issuers that are having to issue bonds in this pandemic environment just to stay alive. I mean, Carnival Cruise Lines has done 4 different bond offerings in the last year. They've had to pay a coupon as high as 10% because they are the epitome of a junk bond. And they're literally issuing bonds just to stay alive. And I just saw before we got on the air here that Carnival has announced another 3 months before they can open up the boats. We're now out to May. So I'm sure they're going to come into the market and try and borrow more money to stay alive. So you've got this kind of perfect storm of low interest rates, but also some corporations that just desperately are in need of money here. So as a result, we got more bonds coming to market at a time when, you know, there's a lot more risk in the market. You know, we had 58 fallen angels created last year, 58 corporations that got downgraded into junk. Corporate America is going through a downgrade.
Yeah.
But yet yields you're getting on your bonds do not reflect that. And we'll talk about the yield side in just a moment. But I just wanted to express, we just got a boatload of supply coming into the market here. Municipals, the same thing, right? With municipal budgets being killed,
right,
they're having to issue more bonds. So we're in a credit frenzy of everyone out there borrowing money.
And as they should. And I'll give it, for those that might get confused on all the terminology and things, I'll make a very simple, I love basic, simple analogies. This one will be very G-rated. Sometimes my analogy is borderline on PG-13. If you think about what happened for Christmas, you guys might remember if you're trying to buy the PlayStation 5, every place was sold out of them. And if you, it's a $400 device, maybe $300, depending on which model you get. But let's say it's $400 device. If you tried to buy one right around Christmas time, because the supply was so short, you were going to pay $1,500 on eBay, on Amazon, by scalpers because supply was so short. But if they did what happened with the bond issuance and gone from $8.5 trillion or $8 trillion up to $12 trillion, then all of a sudden you're getting 50% more supply. What would have happened is no longer would you have been forced to pay $1,500 on a scalped market. You would have actually been paying much less because there's a lot more of them and the scalpers couldn't demand that kind of margin. So it would have helped from a supply and demand perspective. Now in this case, you know, you have all of a sudden a huge increase in supply. What that does now, it's almost flooding the opposite way. It's flooding the market. So you are basically crushing the price of bonds, and to entice people to buy this stuff that nobody wants, you're going to have to pay a higher yield. And that's very evident when we look at your first chart. I'm going to bring up that first chart that you have there, which talks about the yield curve, because that's very reflective of this example that we're talking about. You want to walk us through that?
Yeah, and I've got the charts up finally too, so I'm with you. The real message that I want to get across to the OTA community as part of this discussion is the fact that, you know, for 2 years at least, Merlin, you and I have been talking about the fact that, you know, we had an inverted yield curve, interest rates were going lower, the Fed is bringing rates down, and so on. And you and I spent 2 years talking about a declining interest rate environment. That is exactly the opposite as we sit here today, and we need everyone to understand rates are going up. That's not a question, are rates going to go up? Rates are going up.
Right.
So, for example, if you look at this chart that you have for people to look at, the blue line on this chart represents today's Treasury yield curve. This is the rates of return you can get on Treasuries today. And the U.S. government issues Treasuries with maturities as short as 1 month, down there on the lower left-hand side, all the way on out to 30 years. Now, the popular benchmark that a lot of your listeners watch, I know, is the 10-year, the TLT and the others. So let's use that as our benchmark. In September of last year, so less than 6 months ago, the yield on that 10-year Treasury was 0.5%.
Yep.
That's where it was. By the end of the year, we were up to 1%. And that's when we were talking about all the supply coming into the market, rates are going higher, the government's got to flood the market with long-term debt, and it's exactly playing out exactly as we foretold. And now, as we sit here today, the yield on that 10-year Treasury just this afternoon went to 1.4%. We've gone from 0.5% to almost 1.5% in 5 months.
Yeah.
It's been dramatic. And
Now,
it's going to go higher.
Right, and unfortunately, I don't have a straight drawing tool here. I have a pen. That doesn't really help me, guys. I was going to basically show you the slope. What I want you to notice is the difference in how it's accelerated. So if you look at this beginning, I'm going to circle in red here. You have this, I'm looking at the beginning of 2019, right? And then you look at, February of 2019, you can see with these two little red circles, that's a normal yield curve, right? It's slowly sloping up. That's supposed to be. And basically what that means is, for those that don't know, the longer you commit your money for, the more you should be paid for it. And in this case, if you're committing to a 30-year back in 2019, you're going to get about 3.1% interest. If you're only going to commit yourself for 1 month, you're going to get about 2.4%. And this is normal. If you look at the middle one, which is 2020, you see a very dramatic change in the way that yield curve looks. It really just dipped down. I mean, isn't it kind of weird that if you invested your money for 1 month, you were making about 1.5%, but if you invested your money for 2 years, you're making less than 1%. I mean, why would you want to do that? Why would you put your money in the 1 year, the 2, the 3, the 5, the 7? The only ones you want to put your money in would be like the 30-year or the 1 month. And now, if we look at the blue line that Bill's talking about, what's noteworthy here is how steep this line is. This is the part where I think people are feeling that we're in the bond bubble because, remember, the Fed controls everything on the left-hand side of the screen. That is Powell saying, hey, I'm going to do this, and these are the rates. We're going to stick it to wherever we want it to be. The right side is free market. That's supply and demand. And noting that the market is rising so quickly with regards to yields, that's what I think most people are referencing as far as this bond market bubble. And that should be of concern. Today, Bill, we saw, let me see if I can bring this up here. Bear with me as I scroll through a bunch of stuff. The economic announcements from today. Here's the economic announcements for today. New home sales. Right, I mentioned that because the cost of capital is so cheap, I anticipated this new home sales number being higher than 853,000. We came out at 923,000. That is a pretty massive increase in the number of new home sales. And why? Because the yields are so cheap right now, and people realize that in the next 3 months, 6 months, a year, they're not going to get a 30-year fixed for under 3%. You might all of a sudden turn around and be lucky to get it for under 4%. So there's a rush right now, which to me, Bill, is interesting because not only is it fueling the bond bubble because people are chasing it, but it also fuels the housing bubble. I got a double whammy going on here.
Oh yeah, you do. There's actually, and there's one other aspect of this bubble though that I have to be sure we stress. I like you and other traders, I don't mind taking risk if I'm being compensated for it.
Yeah, right.
But the further problem is if you're buying corporate bonds right now, you're not being compensated for the risk. When you think about it, all this supply of bonds being dumped into the market should have increased the yield on these bonds or the credit spread on these bonds. But here's the issue. If you look at a portfolio of corporate bonds today, and I'm going to use a Bank of America index here, but traditionally before the pandemic hit, a portfolio of single A rated corporate bonds with a 10-year maturity got you about 1% better yield than treasuries. And as you all know, that's called the credit spread, the difference between a bond and the treasury. Right. So a corporate bond, single A rated, you get 1% more. Now, when the pandemic hit, that blew out to 4%, meaning you got 4% more yield by buying a corporate bond. And that reflected the risk of the pandemic and everything we all lived through. Well, what happened is since March of last year, that spread has now declined so much that now the credit spread on a corporate bond is narrower, less yield than we were before the pandemic. That makes absolutely no sense. Yeah. Here we've got more supply has come into the market than we've ever seen. We're seeing greater credit deterioration than we've ever seen, more downgrades. And yet, counterintuitively, the yield on your corporate bond is less yield than we've ever seen before. There's your bubble. Mm-hmm. This market's going to correct. And when the market corrects, you're talking about a major price deterioration to get those yields back up to where they should be.
I've got your second chart here, which is understanding the M's of money supply. And I wanted to bring this up just because you talk about how they've been creating so much. I think it's the acceleration. And these two images kind of go hand in hand. the understanding the M's and then the one after it. But what's crazy here is how long it took us to get on the on the money supply from. I mean, gosh, in the 70s we were at like 200 billion. And all of a sudden now we're at almost, we're over it now, but I think we're close in this illustration. We're at almost $7 trillion. But you see three distinct phases here, everybody. You see this one from the 70s to, I'm marking in red on my screen, to right about 2008. And then from 2008, you have this accelerated piece that goes all the way up until 2020. And then all of a sudden we get the current one that we're in. And you notice three distinct slopes here that are just incredible. Now, the one from the 70s through 2010, I'd call that sustainable, right? That's normal. That's just devaluing of currency as we know it. The accelerated move really started to happen for, our financial crisis. And then all of a sudden, it's like, what in the hell is going on in this last year? You've seen a lot more than I have. Go ahead.
Yeah, that M1 is up 76% in 1 year. that spike that you see at the right end. Now, I think we should explain it. I'm sorry. The reason we did this, the reason I sent you these slides is right now M1 is kind of big in the news. The talking heads on TV are talking about it a lot. And just to explain to the group, M1 is literally the amount of cash in our economy. This is literally the money in your checking account, your savings account, the cash you and I walk around with. This is the most broad, this is the measure of true liquidity cash in the market. And what you can see here is that the amount of cash in our economy has absolutely exploded.
Yeah.
But honestly, you and I and your audience at OTA shouldn't be surprised because we've actually been talking about the same thing from a different angle, and that's the next slide. Because, under quantitative easing, starting in 2008, by the way, look at that slide, our Fed started quantitative easing and they started printing up and creating money. So I don't understand, honestly, why the press is so surprised that M1 is exploding, because the amount of money the Fed is creating under quantitative easing is exploding. And that's the next slide. The third slide I sent you is the one you and I have used before, which shows the Fed's balance sheet.
Yeah.
It's not a coincidence that these two things look alike, because the Fed's balance sheet is just another way of saying all the bonds we bought with the money we printed and threw into the economy. And then M1 is showing, there it is. There's that money.
Yeah.
The point is, we as an economy, we are literally awash in cash.
Well, Bill, this is one of the reasons that people like myself and some of my viewers out there are so big on cryptos, because when you look at Bitcoin, it's like saying, well, screw you for holding dollars, because you're devaluing that almost every single day by printing like this. And basically, for everyone that doesn't understand, when you see this happening, when you see these big spikes up, think every time this goes up, that's weakening the US dollar. When it drops, it's actually strengthening. And there's a couple periods where it actually did strengthen. But for the most part, it's just weakening the US dollar. So, we look at Bitcoin and I'm thinking, this allows me to sidestep some of the manipulation the government does. Now, of course, you saw the comments from Janet Yellen over the weekend, basically saying that she's, very concerned about Bitcoin. That it's not a great source. I think she's not good as a source of money. I'd love to get your take on what Janet Yellen says about digital assets, because clearly Powell said it, and I think we all understand that we will be without cash in our markets probably within the next 5 to 10 years. We'll all be completely digital.
Yep. No, I think, and I have to make a distinction. I am a late arrivee to the cryptocurrency market, and being a believer, but it is for some of the reasons you just said. So I'm on board. You're right. The dollars get devalued just literally by holding them. I also think Janet Yellen's comments were not surprising, because do you really think there's ever going to be anywhere a central banker that would advocate the idea of a fiat currency away from their own?
Right.
So the fact that Janet Yellen and the Treasury or even the Fed are against it, I'm not surprised at. But I also do know, and I'm not saying anything, that the Fed is looking at cryptocurrency as a way of settling securities business.
Yeah.
So at the same time, the government is saying we're not behind Bitcoin. Cryptocurrency as a concept is one that's, going to enmesh whether we like it or not, I guess is what I'm saying.
Yeah, I agree.
So the Fed is looking at digital currency. That's a fact.
Oh yeah, and they're threatened. I mean, you can hear their comments. It's almost like they're scared of Bitcoin, and you have so many institutions now buying into Bitcoin. It's interesting, but we won't make this about cryptocurrency. Still want to stay on the bond side of things. So what's your prognosis going forward here? We have, especially in the last year, seen an unbelievable steepening of that yield curve, which you called out. You said, I think we can go back and show, the title of the show was called The Steepening or something. It had like a horror picture with blood dripping on the screen. We're there, so kudos for nailing it exactly as it's going to happen. Where do you think we go from here? I mean, are we going to see these 30-year, mortgage rates jump to like 5, 6, 8% in the next year or something?
Yes.
Wow.
Yes, I do. And let's talk about mortgages specifically, because I think that affects everybody. Just to give you some context here. When bankers price 30-year mortgages, they price it to the 10-year Treasury. That's their benchmark. So, when the press quotes us what the 10-year Treasury is doing, they're implied also showing you what's happening with mortgage rates. Now, so the correlation between 30-year mortgages and 10-year Treasuries literally goes back over 75 years when they go up and down together. So what happened was back in 2020, when the rates were cut, the Fed dropped interest rates, quantitative easing, the 10-year Treasury I mentioned went down to that very low level of 0.50. Mm-hmm. And it was at that point that 30-year mortgages were then at what was then the lowest level, national average of about 0.27. Now, what's happened since that point is the 10-year Treasury has gone up dramatically, as we've already said, by almost a percentage. But yet 30-year mortgages haven't. They've disassociated from each other because there is, as you just expressed, a strong housing market going on.
Yeah.
There's strong demand for mortgage money right now. And mortgages are subject to supply and demand, just like anything else. So with that strong demand for mortgages, the banks, to compete for that business, are having to offer lower and lower yields. So whereas the mortgage rates should have gone up considerably by about a percentage point in the last 5 months, they haven't because of that strong demand. But let's be honest, it's highly inconceivable that that type of demand is going to remain. So even if 30-year or even if 10-year yields remain unchanged in treasuries, we should expect that mortgage yields should go higher to catch up again, because they're lagging behind.
Yeah.
That's in spite of the fact we're expecting long-term yields to go up even further. So even just to play catch up, we can look for an increase in mortgage rates. So I'm not here to give personal advice, but the dynamics of this means, if somebody's looking to refi, you might be well advised to think sooner rather than later, or if you're looking at property.
Yeah.
I agree with you. We're going to look back at 2.7 or 2.0 as incredibly cheap 30-year money.
Yeah, and I think you're right. And I'm noticing in my neighborhood, there was actually my neighbor down, literally on the corner here. They put their house up for sale. 9 days later, they had multiple offers, and it went for more than they wanted. And that's happening all across my neighborhood. And I think that people are, when you run the spreadsheets, if you take a spreadsheet and say, if I pay more than the house is worth today, like above asking price, is that a bad move or not? Well, if you're going to have a 30-year fixed mortgage at 2.75 fixed rate, it's probably, if you're going to hold it for 30 years, it's probably a good deal because over time, those rates, that mortgage rate is going to be back up to 5, 6, 8, who knows, hopefully not getting back to the 80s level, we're up in 16%, but getting back to normal, you're looking at 5, 6%. I think you might consider to be a normal price for a 30-year fixed mortgage, and that would squeeze a lot of people out of the market. So this is a very interesting time to be in this bubblicious type of environment.
Yep. If I could illustrate, I don't know how much time we got, so I don't.
Plenty. You do whatever you need to do. You're the one who's been talking all day.
All right, well, thank you. If I could show you, though, what the bubble bursting looks like a little bit, because we actually have a representation of that. The last slide that you're looking at here is an ETF that a lot of the OTA community is familiar with. It's the LQD. Mm-hmm. This is a investment-grade corporate bond ETF. So it's a very plain, basic investment-grade portfolio with an average 10-year maturity. Now, because interest rates came down last year, that means prices went up. This portfolio had a 2020 annual return of 7.5%, which for a fixed income corporate bond portfolio is not bad.
Right.
Particularly when interest rates in general were running around 2 or 3%. And the reason for that is because interest rates were going down, the price of this ETF was going up. It's just that simple. So last year we got a 7.5% return out of this fund. But as we've been saying, for the first 2 months of this year now, interest rates have reversed. They're going higher now. And look at what's happened to the year-to-date performance of that same fund.
Yeah.
Because of that same interest rate risk, and now because interest rates are going higher, that fund that gave you 7.5% annual last year is already down 3% in just 2 months this year. We haven't even finished the second month, and we're already down 3%. It's given up half of last year's gains almost in 52 days.
And I just put up a price chart of it, you guys. This is LQD. And this is, again, is that investment grade corporate bond fund. You can see been dropping down pretty a good day today, but all in all, this is a sign of weakness. I think that we think about what Jim Rogers talked about yesterday. You could simply go short these types of bond funds. And of course, this is just one of many. TLT is probably one of the biggest ones out there, but look at the chart of TLT. You normally don't think of bonds moving that much, but if you go back to just July of last year, TLT was over 170. And now it's at 140. Right. I mean, that for bonds, that is a significant decline in value. Because remember, bonds are supposed to be safe. Bonds are supposed to be that investment vehicle that, you're old, you put your money in bonds and just sit back and let the income stream happen. Well, yeah, get your income stream coming in, but if the value of the asset that you're getting the income stream off of drops 20 or 30%, retirees are going to be hurting.
Yep. And that's really the message I need your listeners to understand is we are in a completely reversal situation from where we were last year.
Mm-hmm.
Last year, the bond market was the place to be. It's hard to make that argument now unless you're trading it to the short side or some other way. And by the way, on this LQD, because I just happened to look at it for something else, the short interest in that has risen from 5% 2 months ago to 15% now.
Wow.
So, people are trading that to the short side, and that makes sense for those people who are comfortable with short selling.
Yeah, well, hey, we'll get them on GameStop, and next thing you know, this thing will shoot up 300% in 2 days. Get them on Wall Street Bets.
That's right. Put it out. By the way, I saw your video with Larry that you did this week on that situation. You guys did a great job. That was time well spent to watch your debrief of that.
I tell you, that was one of the most frustrating things to see happen. And by the way, I saw Big Ed was giving me a hard time because he says you can short it again. I don't know if you guys saw GameStop today. It's up another 250% today. But, when cooler heads prevail, I guess from a shorter-term trading perspective, yeah, there's a lot of action there, and certainly there's opportunity. But if you just think long-term picture, guys, is there anybody in this room, anybody, or do you know anybody who believes that GameStop is going to survive, let alone go to 1,000, but just survive the next 10 years, or 5 years even? I'd be hard-pressed to see anybody that thinks that they're going to make it in the long term.
Maybe the market just hated the CEO. Maybe the stock's up 250% because the CEO stepped down today.
That's what it is. He must have been that guy. Hey, you know what? He probably sold out his shares at $480. He's like, I'm out. I'm done.
I'm out there. There's a 1-year contract. That's all I need.
Loves it. Let's see. This is let's see if we can get this question in from Alan. He says, so M1, M2 are steep, but the M1 versus M2 are declining, meaning short-term deflation. Should we expect inflation later?
I'm not sure I agree with that second premise. I'm not sure why that represents deflation. It just means there's more assets in cash than there are in money markets or mutual funds. So
right.
I would ask him if you have time. I don't know to clarify that. I mean, the fact that it's not going up as much, I respectfully, I don't know that represents any sort of deflation.
Right.
That doesn't matter the question. I'm sorry.
No, I think you're right. I think it is more of the aggregations or the groups of M money supply, M1, M2, M3, basically tells you where it's allocated at. And I agree with you, but I don't think it necessarily reflects inflation or deflation. But I think that we could surmise from the amount of increase in M1 and M2, regardless of the numbers, how they relate to each other, but just overall money supply increasing, ultimately, I think the answer to should we expect inflation later, every textbook in the world that teaches Keynesian economics is going to say, yes, we should expect inflation later, right?
Absolutely. And I've been saying that, but in fairness, I've been saying that since 2010 when the Fed started printing up money. Where's the inflation? And the reality is we're yet to see it. And It's kind of throwing, because I grew up in the same era you did. I'm a little older, but, I'm a Keynesian kind of guy. That's what we all learned in college and grad school. The question we're all asking is, where's the inflation? The velocity of money is just not there. And Keynesian economics almost seem like they don't work. That's why modern monetary theory and some of the things you also talked about, we're all asking the question, where's the inflation? But in fairness, I've been asking that question for 12 years.
Yeah, I know. Me too. And it makes me question my education. People ask me quite often, well, did you find that your finance degree really helped you as a trader? And I would say it was actually detrimental to me because it showed me this utopian way that the markets are supposed to operate because of efficient market theory. Markets operate because of inefficient market theory. There's nothing efficient about them. They function because everybody has different information at different times. So it was a struggle for me, and that's one of those, I guess, industry truths, so to speak, that you keep increasing money supply, you're going to see inflation and ultimately hyperinflation given how much we've increased. But you haven't seen it. I mean, it's really not that representative of our markets. And even Powell saying, hey, we want to have 2%, but, we're not there yet.
We're struggling to even get 2% inflation out of this economy. And yet, with all that cash in the market, with all that, helicopter Ben Bernanke was nothing relative to what Powell has done in terms of raining money on the economy. We all have to admit inflation is not, well, I say that, just let's put a cautionary note. The inflation number for January was actually very high. If you go back, that January CPI number was high. Mm-hmm. Now, the question is, was that the start of something or was that just an aberration?
Right.
Yeah, was that just a one-off? But, if that continues, I think the number ran at 6% annualized, as I remember it. So, it was so high, people were viewing it as aberrational. But, maybe that's the start of something. I'm not saying that, but I just should point out inflation last month really did jump up quite a bit.
Yeah, and Alan's here saying, how come many say we don't see inflation? Well, we see inflation now, and I don't think Adam, I don't think anybody's saying that we don't see it, but just not to the magnitude that I believe we should be seeing it. I mean, I talk about it all the time. One of the things that pisses, don't get me started with Red Stripe beer, right? It used to be a 12-ounce bottle, now it's 11.2. Who's sipping all that extra beer that's taken away from me? The price stayed exactly the same, but all of a sudden the amount I'm receiving is less. To me, that is inflation. But when you look at a metric like CPI, it's saying a 6-pack of beer costs this much today, 6-pack of beer costs this much, in a year. They're not accounting for it going from 12 ounces to 11.2 ounces, right? So we are seeing it, but are we seeing it at 10, 12, 15%? Maybe for some asset classes, but overall, it doesn't seem to be as astronomical as people are forecasting because of all the money that we printed.
Yeah, and you're right. The way we compute CPI and the fact they do it as a survey, and it's just absurd. But the point is, we want inflation. One of the things I stress with every class I feel like I'm doing these days is, please understand to the audience, inflation we want. We want some inflation. Right. A manageable level of inflation is good. I would propose that most of your viewers would like to see their paycheck go up every year. Mm-hmm. That's inflationary. I'm sure you want to see the value of your house go up every year. That's inflationary. Right. The value of collectibles, art, wine, Legos, I don't care what you collect, you want the value of them to go up every year. All of those are inflationary pressures. We all want some inflation, but we want manageable inflation. Right. And what the Fed's told us is they perceive that to be a 2% number. That's the level of inflation everyone should feel comfortable with. Right. But we haven't been there in years. So what the Fed has now told us is, don't worry about it. Even when inflation does start rearing its ugly head, because it's been such a low number for so long, we need to build more inflation into our economy. So that's why when inflation does start rearing its ugly head, which as a traditional Keynesian economist like you, I think it ultimately will, the Fed's not going to be so quick to respond like they did in years past. They're actually going to let it ride for a while. Right. That's a very different philosophy. It scares me a little. It's different.
It definitely scares me too. I mean, the unknown is always a challenge, but we'll always adapt. I think that's a beautiful part about being a trader. I'm going to read this question from Tony. I haven't read it yet, so I see the question marks in front of it. Tony knows the rules here. If you have a question in chat, just type in a couple question marks before so I can scroll through and see it. It says, in my retirement account, I can pick either bonds or stocks, large, mid, small cap, and international. When things go down, where would you put your money? By the way, I cannot. Sure. Here's, I think, the challenge to this one, Tony, and it's if we are, in fact, in a bond market bubble. Remember, corporations are using debt, right? They're using this debt to help facilitate their operations and consuming more of it. So if all of a sudden the yields start to spike significantly on that debt, any company that's issuing new debt is going to have to pay more, which would further constrict business. So while it would be bad for the bond markets because obviously the bond prices would drop, yields would rise, it also is going to impact the equity markets. This is one where the bond market, I think, brings down multiple things with it. I think it'll bring down the housing market. I think it could bring down the stock market as well, which is why I think what Jim Rogers said the other day was rather interesting. He said, this will be the biggest bubble of my lifetime. And this guy's been trading for 57 years. He's seen some serious bubbles. Not quite the tulip bubble, but he's certainly going back in time a little bit. So, I think that ultimately, where do you put your money? I would say go to cash, right? Especially if you're long term. I wouldn't think of international markets. I would simply go to cash because most likely the bond market, by imploding, will bring most asset classes down with it. So just go to cash for a little bit. You can do that. There is a cash equivalent mutual fund, usually in a 401k plan or in investment plans like that. So you can stick it in that cash, and just wait it out. It's better to be making, 0.01% interest on your account than losing 20, 30, 40, 50%.
I couldn't agree with you more, Merlin. I mean, the cash and short-term instruments, like short-term T-bills, which are basically like cash but give you some interest, are the haven of safety. But I also want to point out that, rising interest rates could be a positive if you have a floating rate bond.
Mm-hmm. Yeah.
So much of the bonds we talk about are fixed rate because that's the U.S. market, but there is a whole universe out there of floating rate bonds. And what that does is that turns a negative into a positive, right?
Yeah.
Because now if interest rates go higher, the coupon on your bond will go higher. So in a declining interest rate environment like we've been in for the last couple of years, you wouldn't want floating rate bonds. That would have hurt you because your coupons would be going down and down and down. But now that situation is reversed. I'm not saying in Tony's particular case specifically, but for income-oriented investors, they might start thinking again about floating rate products. Remember our old tips conversations and things like that?
And that might be
back into vogue.
Yeah, and that might actually be a good thing. So to go back to the question, was it from Adam? I forget what the question was. It's from Tony. The guys in here saying precious metals. Certainly, that would be, if you take all the asset classes and think about markets crashing like that, I would say yes. Precious metals would be a good spot. Here's the only challenge I have with Bitcoin. Alan says even Bitcoin, and you guys got to remember, I'm probably one of the biggest Bitcoin bulls around. You got to look at it. So people are keeping money in Bitcoin and the markets go to hell in a handbasket. They're going to be looking for money, meaning to pay their normal bills. So I'd be a little bit wary about just even Bitcoin because people might be pulling money out of that. And of course, that causes sell-off. Certainly the supply numbers and the demand increasing around the world tell me that Bitcoin will probably continue to go up over time. But if we do have a major meltdown like 2008, I can see almost everything being pulled down with it. That's why I think cash is the safest way to go. But as Bill pointed out, you have bond products that will adjust the interest rate. So you can actually get an adjustable rate, the TIPS, right? TIPS is one of the main ones. And maybe you have a sort of fund out there that you can invest in that is an adjustable or floating yield on those bonds. That might be a way to go as well.
It's one way to try and turn a negative into a positive. But again, you still got the credit risk of the bond issuer and all of that. But, conceptually, floating rate bonds could make sense in a rising interest rate environment.
Yeah. Yep. All right, Bill, tell me a little bit about your upcoming teaching schedule. It sounds like you're working for the big guys, the big institutions that a lot of people go boo and hiss about, but you are seriously busy man teaching. Were you doing any classes that my audience can attend?
I am, and it's busy everywhere. I'm really pleased to announce that, two things going on. We were doing the Bond Aid Signature Series, and originally we thought we'd do a monthly schedule on that. It was something new. We've decided to go to a quarterly schedule on that. So the next class for the 3-day Bond Aid Signature Series will be in May. But in an effort to try and get in front of the OTA audience more, which I really enjoy, and Larry has been a real advocate of, I'm going to start doing some XLT classes, and the first one will be next Tuesday. So we're going to do bi-weekly XLT classes on the topic of bonds, interest rates, what we're doing here. So that'll be a whole new avenue for me to participate to the OTA community. So those are already going on the schedule. The first one is next Tuesday. And then we also do the Signature Series showcases. That's hard. You and I have done those together. We do those every 2 weeks as well, where we promote the Signature Series classes that we hold. And people are open to participate in those. They run about an hour and a half, and we take a topic and we kind of get into it in some detail. These are topics that come from the 3-day Signature Series class itself. So in spite of my institutional business getting much busier 24 hours a day, I'm also doing more business with OTA, and I'm really enjoying that.
Well, good.
You guys are a lot more fun than my institutional clients.
Well, I appreciate you still sticking with and giving some attention to the little guy out there, right? We certainly appreciate that.
That was fun. I'm blessed.
Yeah. Well, what else is new in your world? I know we always talk about bonds. Anything else that's of interest to you out there?
I'm looking at the whole GameStop thing like everyone else is, but I'm looking at it from the operational side of the business because I actually started in operations. The fact that we've got these dark pools, it really, to me, shows the inefficiencies of the exchanges here in the U.S. So this is a side issue, but, the technology, DTCC is a client of mine. They are the settlement system for the U.S. and the clearing and the depository. And there's just such archaic operations that support our business. That's why these other venues for liquidity are popping up. Yeah. I don't mean to jump on the bandwagon. We got a real problem with the exchanges here in the U.S. They're not providing the liquidity that we need, and that's why these other venues are popping up.
You were mentioning to me when the whole GameStop thing happened about the clearinghouse issue and how the deposit requirements all of a sudden spiked up. Does that concern you as well?
Absolutely. And the fact that some of these firms are self-clearing, that scares the heck out of me. Mm-hmm. The whole purpose of centralized clearing is to improve the credit risk. Well, if you start letting individual firms self-clear, what's the sense? No, the structural I don't mean to be a downer, but the structural operational aspect of our trading markets scares me right now. The exchange, look at it. This number just blows me away. Of all of the stocks that trade on the New York Stock Exchange, and there are over 2,600 stocks that trade on the New York Stock Exchange, if you look at the fourth quarter of last year, only 12% of the trading in those stocks occurred on the exchanges. 88% of the liquidity in listed stocks is now occurring away from the exchanges.
Wow.
That concerns me. Are the regulators really on top of this? Or is the individual being protected?
Yeah.
I'm concerned.
Yeah, I am too. And Robinhood was very, very close. As you can hear the testimony, they were very close to shutting down altogether, not just a couple stocks. So that was really interesting. All right, last question. Again, Jim Rogers on, and he said it's going to be one of the biggest bubbles he's ever seen. Adam says, does Bill agree with Jim about the bond bubble being the biggest?
Yeah, well, I've lived through a couple of bubbles. I like Jim Rogers, which is why I'm surprised. We actually had a bigger bond bubble back in the 1980s. If you remember a name of Mike Milken and junk bonds and Drexel Burnham, we actually had a bond bubble burst in the 1980s that literally destroyed the savings and loan industry.
Right.
Some of you out in Irvine might remember California Fed Savings and Loan, Columbia Fed Savings and Loans. These are institutions that were wiped out by the junk bond bubble of 1980. So that literally destroyed the banking industry. So that was the biggest I've seen. But I honestly do think that we're going to run close to this. We got to get people prepared for the fact what the Fed has been doing, in my opinion, is creating bubbles. And I think the credit market is one example of that. I think we owe it to you to get a cautionary note out there.
Yeah, I agree. I think this one, I wasn't around for the savings and loan one, but I think that this is bigger because I think it's more entangled in all asset classes and all across the markets, where it seemed to be a little more centralized in the previous one. So we'll have to wait and see. Ultimately, that's all we can do. Everything we talk about here is simply our opinions and hypothesis about what's going to happen, but you never know. We'll just have to hopefully be on the defensive side when it happens. Bill, thank you so much for coming on. I appreciate it. I look forward to maybe attending some of your signature series classes out there.
And thanks for all the great work you do. As I said, that video you did this week with Larry on the situation with GameStop, just as impressive as hell. So thank you for the work you do as well.
Oh, thanks. Hey, you know what? I'm like you. If I can share my knowledge and help make people's lives better, then that makes me happy in the process. So, and thanks to you, all the work that you do.
Very cool. Have a good one, guys. And please, everyone stay safe. Let's be safe out there.
You got it. All right. Take care, Bill. Thank you.
Cheers.
Bye. Yeah, that was Bill Addiss. Bill Addiss does a lot with Online Trading Academy teaching classes. He's got a signature series as well, which I would encourage you guys to check out. There is quite a lot of information behind the scenes there at OTA for you to check out. And when Bill, it's unfortunate we don't have a specific bonds class. We've been talking about it for a long time. But boy, I tell you what, just even picking his brain here on this program and getting some thoughts to me on the markets, on the bond bubble, interest rates, etc., has opened me up to a whole bunch of different investment vehicles, especially things like bond ladders, barbells, tips and strips, and all these different products that I was normally not familiar with. So anyway, I hope you guys enjoyed that. If you want to find out more about Bill Addiss, you can go to tradingacademy.com to find out more about him, and also talk to your local center if you'd like to take some classes with him. He's also got a bunch of stuff he posts on Instagram, LinkedIn as well. Now, Alan G says, wasn't the 80s good? 70s was bad? 80s was great. You know why? Disco, baby. There's a music, a genre of music that was never sad. Everybody crying in disco. Now all these sad country songs makes me want to just go cry a river. First song I listened to the other day, I asked Alexa to play some. I shouldn't even say her name. She can probably hear me. To play some music. She goes, "I'll play the top hits." And of course, what was the top hit? Some country song. And the first thing the guy says is, like, my truck's broke down and I'm gonna have a beer and my dog something. I'm like, really? You said the key words to all country songs: dog, truck, and beer. May as well just talk about tears and crying. Anyway, sorry to go me a rant about music. Yeah, 80s were good, except at one point we saw 16% for a 30-year fixed mortgage. You talk about pricing people out of a market. Now, they had to do that because inflation was getting out of hand, right? So Volcker says, I'm jacking those rates up. And lo and behold, that's what happened. Now we're going to the... Oh, Big Ed, you don't like disco? Come on. Man, I got some bell bottoms lying around somewhere. All right, let me see. There was a couple good questions in here that I thought were pretty, and I want to get to. There was one gentleman asking about his wife's. Rob says, my wife is in a target date fund, 2035, more bonds as she gets older. How would or could this impact her investment? It's a great question. It all depends on the types of products that she's in. I mean, obviously, if she's in specifically bonds, she's going to be obviously collecting the payment stream from that, so that isn't as much. If it's a bond fund, she could be impacted significantly by the drop in the value of those bond funds, because normally those bond funds, what they do is they'll hold a portfolio of bonds and they'll collect a premium and they'll pay out that as a dividend or just an interest payment on that fund. But as we saw, some of these bonds like TLT, I assure you that if you own a bond fund that's got a bunch of different bonds in it, it's probably going to maybe even have access to TLT in there, which is just the 20-year. As we've seen, the price of that TLT has been falling. Let's just go TLT again. You know, it's a pretty sharp decline, and it may not look that bad. And if you think about percentage gains, I mean, look, the drop in TLT, this is like just one day for Bitcoin, right? It's down almost 10% in a month. That's huge for bonds. If we go back even further, will be a problem for her because she's probably going to be owning some of these bond funds. And as you notice, over the past less than a year, this bond fund particularly, which is the 20-year Treasury, has dropped by 19%. So, you know, you're in an instrument where, yes, you are collecting some income, but the value of the underlying is dropping. So this is a risk to her, which is why if you really feel that these markets are popping, or this bubble is popping, then to me the safest place to go is cash, or as Brendan would say, go into a different type of currency like a digital asset, but get out of these volatile assets which have been manipulated by the Fed and our markets for quite some time. So yes, there certainly is some risk there. What someone said, I love disco. What did I say? I love all music except country. I'm going to make a disco blues fusion just to try something. Perfect. Staying Alive is another Bites of Dust. Good one, Larry. Yeah, I'm pretty much a fan of all music out there, except, you know, when it's just depressing stuff, I could care less for depressing stuff. I've been to a lot of heavy metal shows, and just, you know, you name it. I've pretty much gone to all of them. Okay, yeah, I'll leave that one alone, Alan. But as you've seen recently from, what's that guy's name? He was a #1 country artist, and it just, you know, issued a bunch of racist comments. It's like, okay, great, you know. But we could argue that sadly racism is still a part of our country, but it's, you know, it's a part of every country you go to. There's always some racism towards somebody. It's unfortunate, but that's unfortunately the way it is. Let's see. Let me go to economic calendar and earnings for you guys, just so I can knock that out of the way, because I'm inching closer to a 1-hour show yet again. Big Eb, thanks a lot there. Let's see. I want to show you this happened today. By the way, NVIDIA reported earnings. You guys might have seen that one. They did pretty well. The GameStop thing is just ridiculous. It's just going up. Here is what happened today with those new home sales, which I showed you. We saw crude oil inventories actually show a pretty big spike. I was really surprised to see a number that positive. And this is why I hate the EIA. They're the Energy Industry Council that gives all the estimates on this. I mean, they expected it to be a 6.5 million barrel contraction, and it came out at a surplus of 1.3. That's a difference of 7.8 million barrels. I mean, are you kidding me? What? How could you possibly be that far off on an estimate? Anyway, this is a pretty positive number. Tomorrow is a number that I'm really interested in, and that's going to be natural gas. We'll look at that in just a second. Here's what happened today. NVIDIA beat earnings by 10.7%, so a pretty good beat there. They jumped up. When I took the screenshot, it was 3%. They're up more than that now, I believe. Let's go NVDA. And one thing I love about this, you guys were asking a couple days ago, if you ask many times, I lose track of days. But somebody asked me, said, do you trade earnings announcements? And I said no, because I think it's just a crapshoot. And I said, if you are going to trade an earnings announcement, you could be selling puts, buying call, whatever you want to do, but do it not in your normal zones, but because it's earnings, go way farther out than you normally would, just to be safe and accommodate these big swings. Now, I haven't looked at the updated price of NVIDIA, but I mapped out here on the chart, there's a pretty logical area where I'd be interested in going short NVIDIA. And you guys can see that this red candle, it gapped up, had this red candle, and then just ripped to the south side. You guys can see, yeah, you're all watching the chart there. So right around 597, it had this gap down, which of course is a pretty good sign that there's a bunch of supply there. And then it just continued to rip to the south, all the way down to about 535. And then it rallied back up. So if I was looking to short this, right around 597, 600 would be a logical spot for me. We'll take a peek at what happened today on the earnings announcement. Let's go. There's your 5 minutes. I mean, you want to talk about supply and demand working? This is the earnings announcement. It shot up right to that number. 597.06 was the line I had. It hit a high in this after-hour session of $5.99. So basically went $2 into the zone and is now at $560. So a drop of $37 already. Pretty awesome the way that one worked. But the point I'm trying to make here is if you are looking at earnings announcements, don't go to levels that are close. You're going to have to go really far out. And in this case, a $20 jump would not have been far-fetched or unpredictable. I do like the way that it moved out of this level on that daily time frame, which to me brought it to my attention. But there's your NVIDIA now. It was actually up over that 597 mark, currently trading down about 560. And, you might see it bounce once it gets down to this low right around, call it 550. All right. So, let's see. That was your NVIDIA earnings announcement. Other earnings announcements today, you had Lowe's reporting earnings. They were down a little bit. Net Appliances also down about 8.6%, even though they beat earnings. You had pretty much beats across the board except TJ Maxx. Right? TJ Maxx missed earnings, and they were just slightly down. All right, let me see. Alan says, so to summarize, bond bubble will create greater demand for cash. Where did it go? And people will leave their investments. Well, I think what will happen is, if the bond bubble pops, what it's going to do is it's going to start to threaten the ability for companies to pay their debt because the yields are going to go up significantly. Now, if the yields go up significantly, then all of a sudden, if there's any sort of adjustable debt, that debt is going to get harder for corporations to pay, and that could further constrain their operations because right now it's so cheap, it's easy for them to function. If that happens, then all of a sudden, the companies themselves may start to drop in price. And of course, if we hear about the bubble imploding, everyone will go into a little bit of panic mode like they did in 2001 or 2000, same thing in 2008. That would cause people to start to sell assets, which will trigger selling bots. And also people saying, look, I don't have my money in the market right now. I want it to be in cash because I need this to pay for my day-to-day living because maybe I'm going to lose my job if we go into a deep enough recession or depression. So, it's this cycle where one thing can impact a lot of others. What's unique about this situation, at least from my perspective, is it's not just the bond bubble, but the bond bubble has been fueling the housing bubble. And then the Fed has been fueling the bond bubble, which in turn is also fueling the equity bubble. So I've got three bubbles which have just inflated together, creating one of the biggest bull markets we've ever seen. If and when that pops, I believe it will. I'm not exactly sure when. We could see a pretty significant pull down in the markets. And, that's just the nature of trading. I'm not saying that the markets are dead and broken and will never recuperate. We will always come back. But do we see a 50% drop in the markets like we did back in 2008? Possibly. I don't know. I hope that when it finally happens, I will be building short positions and be in a big short position. I don't want to be holding anything long, and this is why I'm making sure I use stop losses. All right, so there you go, Alan. That's my thought on it. Yeah, Simon says, always great seeing supply and demand work out so beautifully. I did not take that trade, by the way, just so you know. So good for companies that have a lot of cash. Not so much, yes, correct. Companies that are cash, and I think, right now you're looking at a lot of companies make that transition, that move to Bitcoin. MicroStrategy bought another $1 billion worth. I mean, these guys are now into almost $5 billion worth of digital assets because they just don't want to be in that US dollar due to the printing. To me, this poses a whole new set of risks to that company. And if you've seen the chart of MicroStrategy, talk about a roller coaster ride. Here's MicroStrategy. They were up pretty good today to 16%, but remember they were at 1,300 about a week and a half ago, and all of a sudden they find themselves down about 650 yesterday. So call it a 50% drop in a week. That's very Bitcoin-ish type of prices. And why? Because a lot of the balance sheet is in Bitcoin. All right. What about oil? Bubble 2. Well, I think that you'll see commodities do rather well. Which ones? I don't think they're all going to do great. I continue to think that we're going to see oil prices rise simply because of what I mentioned before, which is supply issues and also regime change, changing the rules with a lot of fracking and drilling and pulling back contracts on some of these major corporations. But for me right now, it's just go with the trend at this point. Until we see something change, then we'll act on it. But right now, just go with that trend. All right, let me wrap it up. I got 4 minutes left. I have 3 minutes to get out of here. Economic calendar for tomorrow. It's a huge day for the U.S., by the way. Look at all these announcements. There's like a dozen of them. You have preliminary GDP numbers. You have durable goods orders. You have FOMC member Bostic Quarles speaking tomorrow. You also have unemployment claims, pending home sales, which they're expecting it to increase to 0.2%. God, given the way that new home sales jumped today, I wouldn't surprise me to see it be above that 0.2, maybe getting up to 0.4% increase, as we talked about with the housing market, people just buying them like crazy, trying to lock in those low rates. You also have natural gas storage. My guess right now, you guys see this as negative 323 million or billion cubic feet, or however they measure it. I really think you're going to see this closer to 5, would be my guess. I'm gonna write it right now. I'm going to go negative 500 will be my number. All right, let's see how close I am for tomorrow's show. Other than that, not a lot of major stuff for international markets. You see Japan has retail sales and industrial production as well as their CPI, so I'd say that's probably number 2 with regards to economic announcements for tomorrow. Yes, natural gas will be very interesting tomorrow. My guess is you'll probably start to see it reacting to the leaking of these numbers before the actual announcement, which is supposed to happen at 7:30 a.m. All right, cool. Well, I think if I got it all set here, I'm pretty sure I've covered everything I need to cover with you guys today. I have earnings for tomorrow. One more. Salesforce, Etsy, and Best Buy. Oh, no love lost for me on Best Buy. As you guys know, that's the single biggest losing trade I've ever taken in my life was Best Buy. So I have a little angst on that one. And Pacific Gas. God love the Pacific Gas and Electric. See if they go bankrupt anytime soon. That's what's reporting earnings tomorrow. There was a really interesting comment early on, which unfortunately, there were so many great comments in chat coming through today. I'm going to see if I can find it here real quick before I wrap up. Oh, it was from Batista. Batista, great comment out there. He basically said, Fed investigated massive outage of its intrabank payment system. I find it ironic that Janet Yellen slams Bitcoin, saying how it's not good use of cash. She's very concerned. It's not a good, systemically it doesn't really work that well. Yet your payment system shut down and doesn't function. Did Bitcoin go down yesterday? Did Bitcoin stop making transactions yesterday? How about Ethereum? Did they shut down yesterday? It goes right back to what Jim Rogers talked about, which is this fear from central banks and institutions that their systems are going to be challenged, right? That they're going to have, I guess, problems. One second, I just got a message right here. That their system will be challenged and threatened, and it could very well be challenged and threatened. That monopoly could be taken over. You never know exactly what's going to happen, but to me, it's an inevitability that the Fed's going to try to play hardball with this. They're going to badmouth it because it is a threat to their system. Anyway, great comment. Yeah, their system shut down. I thought that was rather ironic. All right, cool. No, Bitcoin didn't go down. I was acting sarcastically there. They did not go down. All right, that's going to do it for me for today. I hope you guys enjoyed that session. Again, if you want to learn more from Bill Addiss, you can go check out his materials at tradingacademy.com. He's also got an Instagram, I always say Instagram, a LinkedIn page with a bunch of different content on it. He's always got a lot to talk about. Now, tomorrow, speaking of someone who's got a lot to talk about, I have Brandon Wendell on the program. We're going to talk about just market analysis, as you guys have seen on his Facebook page and Twitter. He's just always doing market analysis. So you know what? Let's bring it to our screen and share some of that with you. So if you have any questions for Brandon Wendell or myself, you can always email me. It's pretty simple to do. Just go to TraderMerlin@gmail.com. And hopefully you guys enjoyed today's show. If you did, give me a thumbs up. If you are new, as I see we had some new faces out there, hit that subscribe button, and I will see you all tomorrow. Thanks, everyone. What's up, Bubby? It's alright, we're gonna go for a walk. Almost done, buddy. I got work to do. Give me a second. I know. Give me a kiss. 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 Yes. Give me a kiss. 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 Oh, yes. You're such a good boy. We're going to go for somewhere today. Yes, we will. Oh, boy. Give me a little bit. Give me some time.